Willard here from Kofkin Bond & Co. Thought I'd jump in the chair and give you a little bit of an update as Tony is still recovering from his surgery. August is here, as you all know, and there are signs that spring is just around the corner. I think we're really hoping for some brighter days ahead as we continue to deal with the rising COVID cases and the sobering news on the economic front. The federal budget was postponed until October, but the government gave us a bit of a budget update on July 23rd, which gave an insight to the economic impact of this health crisis. It is estimated that the budget deficit of $85.8 billion in the last financial year, 4.3% of our GDP, actually rose to a staggering $184.5 billion in this financial year, 9.7% of our GDP. This will actually be the biggest deficit as a share of GDP since 1946 in the aftermath of World War II. The economy contracted 0.25% in last financial year and then 2.5% in this financial year, making it the first consecutive annual fall in over 70 years. As a result of this economic slowdown, inflation fell 1.9% in the June quarter. That's the biggest quarterly fall since 1931 during the Depression. And as the biggest price falls were felt in childcare, petrol, primary education and rents. Unemployment rose from 7.1% to 7.4% in June. That's the highest in almost 22 years. Jobless rate is expected to peak around 9% in December and then looks to fall off from there. In financial markets, gold rose to a record high of $1,975 an ounce in July, reflecting in a role as a defensive asset in these difficult times. Crude oil inched up 1% in July, but also down 25% for the year. And in some good news for the Aussie exporters, iron ore prices rebound 8% in July, but still down 7% for the year. The Aussie dollar continued to climb, closing the month off at 72 US cents. Within the Kofkin Bond Portfolios, our growth portfolio was actually got a return of 0.14%, with outstanding results from Apple up 16.7% and Amazon with 9.9%. Some of the losses were Intel Group with negative 18.8% and Royal Dutch with negative 14.1%. With oil prices being at an all-time low, our dynamic asset allocation positions from Morningstar, we continue with the volatility whilst this economy starts back up again. But in the long term, we believe that we have bought in at those Boxing Day sales prices. Thank you for tuning in and looking forward to sharing some more news with you next month.